Yeah, that's right. Some card tricks. Okay. Well, let's see. Counting in. I think that's 8. So we'll start. Good morning and welcome to this webinar where we ask the question, what's new in the carbon market? Although most of us on the call today are market insiders, there are some people in the audience who are new to the subject of carbon market. And so for their benefit and also to put the discussion today into context, a brief explanation, what is the carbon market? The carbon market's grounded in the belief that the best climate policy, both environmentally and economically, limits emissions and puts a price on them. Cap and trade is one way to do both. It's a system designed to reduce pollution in our atmosphere. The cap on greenhouse gas emissions that drive global warming is a firm limit on pollution. The cap gets stricter over time. The trade part is a market for companies to buy and sell allowances that let them emit only a certain amount as supply and demand set the price. Trading gives companies an incentive to save money by cutting emissions in the most cost-effective ways. Companies that cut their pollution faster can sell allowances to companies that pollute more or bank them for the future use. This market, the trade part of cap and trade, gives companies flexibility. It increases the pool of available capital to make reductions, encourages companies to cut pollution, and rewards innovation. In an emissions trading system, or ETS, companies trade pollution permits, often called allowances, which allow them to emit 1 ton of carbon dioxide equivalent. So when a company releases a ton of carbon dioxide, it must give 1 permit back to the government. Our webinar today focuses principally on the emissions trading system, the carbon market in the United States. The Regional Greenhouse Gas Initiative, or RGGI, was the first mandatory market-based program in the United States to reduce greenhouse gas emissions. RGGI is a cooperative effort among 10 northeastern states to cap and reduce carbon dioxide emissions from the power sector. The Renewable Energy Certificate Program, or REC, is a federal program administered by the EPA, and it deals with renewable energy generation. RECs are issued when 1 megawatt hour of electricity is generated and delivered to the electricity grid from a renewable energy source. Much of the focus today will be on California. California's climate policies have led to a steady decline of the state's carbon dioxide pollution. The centerpiece is the cap and trade program, and California's emissions declined 12% between 2000 and 2017. Over that same period, the state's economy thrived. GDP increased by almost 50%, and the population increased by 18%. The California cap and trade legislation was passed in 2006 and went live in January 2013 and is regulated by the state's Air Resources Board. California and Quebec connected their systems in 2014, and in 2016, the state legislature extended the program, codifying a 2030 GHG emissions reduction target of 40% below 1990 levels. California's economy, including power, such as SoCal gas, manufacturing, refining, and fuel supply, is required to hold and surrender allowances equal to their annual GHG emissions. These reported emissions form the basis for entities' compliance obligations. These entities may use carbon offset credits to meet a part of their annual compliance obligation. These offsets are created under a series of protocols that include ozone-depleting substances, livestock, mine methane, rice cultivation, and forests like Malpas Woodlands Group. Forestry projects account for roughly 60% of the total. The cap and trade program has built in some robust checks to make sure that the market functions transparently and efficiently. The offset projects are verified by independent verifiers, such as First Environmental, inspecting each facility and following rigorous ARB-approved verification protocols. The project registries, like Climate Action Reserve, undertake further checks on projects, checking on project submissions prior to issuing offset credits. One final note of explanation. The carbon market uses a lot of acronyms. So we'll hear today include RBOC, which is an ARB offset credit, a CCO, which is a California carbon offset, and CCA, a California compliance allowance. So now we'll turn to Bridget. Bridget, do we have you? I don't think we have Bridget, unfortunately. I will start in just a moment, but I'd like to, before I do so, encourage any questions from the floor at any time. I will then choose those questions and put them to our panelists. So turning now to Mike Emerson. Mike is with SoCal Gas, which is a compliance buyer of carbon offsets. And over to you, Mike.
Well, good morning, everybody. And thank you, Mike, for hosting us today. Good, thanks to the good people at Parhelion and then Opus too for having us all here today. As Mike said, I'm with SoCal Gas. We're for those that are on the webinar here not familiar with us, we're a very large gas distribution utility, natural gas here in Southern California. We have a pretty big footprint. Our gas connects with more than 20 million consumers. So we reach a lot of people here in Southern California. My role has to do with, I cover a number of things. One, I deal with the cap and trade compliance here that Mike just mentioned. We have an obligation with the cap and trade program here in California, and I work to define that obligation and then cover that through the acquisition of these compliance tools. And Mike mentioned those, allowances and offsets, things of that nature. I'm also involved with renewable natural gas procurement and then natural gas hedging as well. So I guess the nature of the call today is what's next in the carbon markets. And to me, again, the carbon markets is for me, my world is California, cap and trade, and then more recently, renewable gas. So what I see, I have a few things I've noted to myself. One of the things I see is a growing nexus between the cap and trade markets and renewable gas. And why is that, you might ask? Well, the renewable gas is a great way for companies like us to reduce our emissions footprint. So we're very eager to go out and source renewable gas. And when we do that, it reduces our compliance obligation in the cap and trade program, right? So when we consider this a very good thing, we're moving, we're using waste streams, methane that comes from landfill projects, dairy projects, wastewater, food and green waste digesters. We're taking methane from these environmentally beneficial projects and cleaning that up and getting that into our pipeline, and that's displacing the traditional fossil gas. And so that's obviously a good thing to get these waste streams, into our pipeline, and people use that gas to heat their homes and cook their food, etc. And then also it reduces our cap and trade obligations. So we spend less money on cap and trade instruments, and that translates at some point into lower costs for our customers. So that nexus is something I see kind of developing in the coming year. A couple other things I see for large compliance buyers like us. I see maybe the large buyers are starting to lose a little interest in the compliance program, meaning buying offsets to meet their cap and trade obligation. And that's simply because in the coming compliance period here in California, The rules are changing so that in the coming compliance period, we can only use 4%, meet 4% of our obligation with offsets, which is unfortunate, given that folks like Dick Kemka here on the call, and I know the Climate Action Reserve's on a call. They do tremendously good work. I've always been impressed with these guys, but being that we can use fewer offsets to cover obligation, I think the interest is waning there a bit with the compliance buyers. But that said, what I see in the community is more interest in the voluntary space, voluntary offsets. How can compliance buyers think about how can we use these voluntary offsets as a tool to reduce our carbon footprint? So I see that evolving. And then lastly, I see interest growing in the secondary market for carbon allowances. So if you're not close to the cap and trade market in California, what we've seen here in recent weeks is the cost of a compliance instrument dropping below the floor price at the auction. So here in California, you can acquire these allowances quarterly at the auction, and there's a minimum price the state will part with these allowances. But compliance buyers can go into the secondary market like futures and acquire these things at a lower price. So I think in the past, some of the compliance buyers really haven't taken a hard look at that. But given that there are considerable savings by procuring in the secondary market, meaning away from the auction, I think there's growing interest and a real economic incentive for compliance buyers to take a hard look at that. So I think that's another developing trend. So that's it for me, and I'll pass the microphone.
Thanks very much, Mike. Very good. We'll move now to Memphis, Tennessee. We'll join Dick Kemka. Dick is with the Mulpus Woodlands Group and is a project developer within the California cap and trade system. Dick.
Thank you, Mike, and thank you for Parhelion and Opus for sponsoring this event. I appreciate the invite to talk from the project developer perspective. I'd like to start with a little bit of background on the Mulpus Woodlands Group, just to give you some perspective of our view of the market. I'm the VP of Conservation for the group. We started in 1905, so we've been around for over 100 years. We were a mercantile exchange that later became a lumber company, and then ultimately in the 1990s we became TIMO, and a timber investment management organization led by Dick Mulpus, who was the grandson of the original owner. And today we manage about 1.9 million acres of timberland throughout the United States and 17 different states. We have 5 commingled funds that are 500 million plus that have a term of about 15 years. So we hold the land for about 15 years. We have 9 separate accounts that are perpetual accounts. As long as we're making money for our clients, they kind of stick with us. The investors are pension funds, college endowments, foundations, and things like that. And we're typically one little tiny sliver of their the assets that they invest in. We're fully vertically integrated as a TIMO, meaning that we're not a few people sitting in a large city with farming out everything else. We have 120 staff. We have the foresters, we have the financial people, and we have 15 different offices throughout the United States. In the last, say, 13 or 14 months, we've acquired 4 new timberland properties. So we're growing, and all of our land is sustainably certified under the SFI program. And we've made a significant investment in conservation and integrating kind of the ESG practices in our decision making. And we're one of the only groups that has kind of a VP level in conservation like myself. So a significant commitment to ESG principles within the company. Moving on to environmental credits and impacts of COVID. Fortunately for us, the forest products industry has been designated as essential infrastructure by the Homeland Security. So we're still fully operational, where some companies are not. My job is to kind of lead anything that's non-timber, so carbon projects, renewables, solar and wind, conservation easements, mitigation banks, things like that. So in the California compliance market, we've done 4 different compliance projects that cover about 300,000 acres of land, and about 3.2 million offsets have been generated from those projects with a value of over, I think we've generated over $40 million in revenue for our clients from those projects. So we're a fairly large operator because we have these big properties. We have 2 more projects at the Air Resources Board right now. They cover about 200,000 acres, and there will be about 4 million tons generated in the initial issuance from those projects. And we're anticipating that they'll issue hopefully later this year. The impact of Corona that we've seen is in one of our big upper Midwest projects, we haven't been able to do field verification that was scheduled, and there's very few, Mike will probably talk about this, but there's very few verifiers in this space for forestry. And when we had to cancel because of COVID and travel restrictions, it was a big blow to our project in terms of the timing. So that's one of the impacts. Of course, no new field inventories, they've been on hold. When you do a carbon project, you have to do both a new, what we call a carbon inventory. It's very similar to a timber inventory where you're measuring trees. So we haven't been able to do that. Our clients and investors are kind of risk averse as well. So any credits that we have, we like to forward sell. So for these new projects, I was going out to sell maybe about 800,000 tons when COVID hit, and the market went from $15 a ton down to about $11.50, and we decided to not go forward with the offering. So that's been another impact. Prices are ticking up now, up 13 plus a ton, but the volumes are thin. So we're kind of holding our breath and hoping that the market comes back a little fuller. In the timber markets, which you have to understand for us are the key to what we do. And timber markets are very tied to housing starts, and housing starts for the last 10 years have been inching up to the point where they got to be almost where they were several years ago in Q4 of last year and Q1 of this year. And of course, with COVID, the housing starts have slowed considerably, and we think there's going to be about 20% reduction in housing starts this year, which means all the dimensional lumber sales will be down about 15 to 20% this year too, which will impact us. One of the bright spots has been pulp, fluff pulp in particular, that's used to make tissue and toilet paper, of course, are extremely popular. So we've seen those remain steady. And the low oil price on the market now makes it cheaper for us to get logs in and out into the mills. But if this continues for a long time, there will be an interesting triage between a timber price and potential carbon sales of annuals from these projects. Each year, whatever timber you don't harvest, annual biological growth you don't harvest can be verified and sold to the market. So that's what I mean by annuals. And future and forward looking, and I'll wind up here. We see with the coronavirus that there will be reduced fuel usage from the airlines and automobiles and so on, which will reduce emissions. We're looking at the California carbon allowance auction right now with great interest to see what the volume and pricing is going to be for this May 20 auction. The California General Fund has been going to fight COVID-19, and the deficit, from what I've been reading, is anywhere from $18 to $30 million. So there's not a lot of money left for other things. The fiscal budget for California for cap and trade would, they're thinking it would raise from, 2.5 to $3.5 million, but it could be as low as $600 million. So there's going to be a potential shortfall there from cap and trade revenue. And so I'm just wondering what the low revenue could, if it's going to impact the entire California program when they see they're not going to have funds for hybrid buses and mass transit and things like that. It may erode political support for cap and trade. So we're concerned about that and hope that isn't the case. And so following along finally with what Mike said, out-of-state projects are going to be reduced in California after 2021. We don't have any California projects, although we have investors that are interested in California. We haven't purchased land there. So we don't have any California projects. And so we're going to have sales in California. And so what's happened over the last 3 or 4 months is we've been approached by 5 or 6 different voluntary buyers that are interested in the voluntary space. And so we've been tracking this International Aviation's Corsia offset program closely, and we're looking at potentially maybe pivoting to some more voluntary projects. So with that, I will end it there, Mike.
Thank you, Dick. Thanks very much. I think in the meantime now we have Bridget. Bridget, are you there?
Yes, I'm here.
Great. Good to, we can hear and see you. So
wonderful.
That's good news.
Great. Well, yeah, first I want to apologize for my tardiness. I am, to everyone on the call, I'm sorry about that. I had a little bit of a time zone mix up. So, but I'm here and ready to update everyone on what's been happening in the carbon markets during this, period of uncertainty during COVID. So Mike, thank you so much for that introduction. As he said, I am a senior editor on the carbon team at Opus. Our team tracks and benchmarks carbon allowance prices in North America for the joint California-Quebec cap and trade program. We also assess prices for the RGGI cap and trade program on the East Coast. For the purpose of this short presentation, I will focus on trade in the California carbon allowance secondary market. It's a solid example of what is happening in market-based emissions programs around the globe, as California's cap and trade program often serves as a policy prototype. Right now, CCA's prices are clawing upward toward normalcy after the most volatile and uncertain time in the program's history. 2 months ago, a COVID-19 related free fall ravaged the cap and trade market, erasing years of CCA price gains in a few weeks. Fundamental anomalies thrived during this time and were in stark contrast to the CCA secondary market's typical homeostasis. Since 2014, Opus observed its evolution from a thin first mover in the cap and trade space to a robust established market. Over the years, trade liquidity expanded to incredible heights, while millions of carbon allowances traded in the secondary market. Market participation increased greatly as hedge funds created speculative demand on the expectation of future price strength. At the start of 2020, prices continued to increase as expected. It maintained the regular contango structure that is a cornerstone of cap and trade. Current year prompt CCAs started January of this year near $17.70 a metric ton, which was $1 more than the program's auction reserve price, or ARP as it's called, of 1668 metric tons. Yesterday, Opus assessed the price of the current year prompt CCA at 1663. So that's just below the quarterly auction reserve price. And that's causing a lot of uncertainty, as other speakers probably have said, ahead of the joint program's second auction of 2020, and that's on May 20th. The ARP not only marks the floor for the 4 quarterly CCA auctions per year, it also serves as a theoretical bottom for the secondary market. By increasing with inflation each year, the ARP safeguards against relatively weak CCA pricing. So heading into the auction next week, California cap and trade market participants are questioning the upcoming subscription rate for the 57 million CCAs on offer. And they're asking the question, why bid for CCAs at auction when the secondary market still shows weakness? So to better understand this, let's examine COVID-19's effect on CCA prices in a bit more detail. And I'd like to just show a chart right now. Actually, there's someone that is still sharing at this moment, so it's not allowing me to.
That might be me. Hang on a minute.
You can move on without it if you want, that's fine.
Does that help? I think I've just done something that might open it up for you.
Actually, no, it's still giving me the same message. That's okay. Why don't we just keep
Work
going
around
here? Yeah, no problem. And I'm going to explain it in detail anyway. So great. So in March, as the COVID-19 pandemic scaled, CCAs unexpectedly reversed course, falling more than $6 to $12 a metric ton. That's a level that the program last saw at its inception in 2013. That's actually quite shocking. Market stakeholders told Opus that the large price decline during that month resulted from extraordinary weakness in the global energy complex and the expectation of lower carbon emissions this year due to stay-at-home orders. The IEA anticipates the same for emissions. They estimated recently an 8% year-over-year global decline due to the coronavirus pandemic. In addition, Opus gasoline demand data shows the potential for weaker carbon emissions from transportation fuels. During the peak of COVID-19 related shutdowns, US retail gasoline demand declined 50% compared with the previous year. West Coast fuel traders and suppliers said they are closely considering the impact of transportation demand and anticipate reduced compliance obligations under the program. So these factors created market uncertainty and this decline in CCA demand that we saw. So as prices began to fall, players such as those previously mentioned hedge funds I talked about earlier liquidated their long positions and flooded the markets with units. So they all completely left in a week span of time and completely crushed the market. Now CCA prices have recovered about $4, marking it an upward trend once again. It'll be interesting to see if it bubbles or how long that lasts. So all of this, the last 2 months have illustrated that policy-driven cap and trade markets are not immune to catastrophe and reversals of price structure. It will be interesting going forward to see if CCA market dynamics react to these lessons learned. And with that, thank you so much. And I will now turn it over to the rest of the panelists.
Thank you very much, Bridget.
Thank you.
Do appreciate that. Next up, Craig Ebert. Craig is with the California Action Reserve. I'm sorry, excuse me, Climate Action Reserve. Take it away, Craig.
Thank you, Mike. I know you mentioned that the focus is largely going to be on California, and that's somewhat logical given that it has the most vibrant market-based system operating in North America right now. But to me, that's the critical takeaway. Here at the Climate Action Reserve, we're privileged to be able to serve the compliance market here in California as one of the approved offset project registries. But as Dick Kemper was mentioning, there's also a lot of interest on the voluntary side. We provide voluntary offset registry services across the US, as well as in Canada, and more recently, we're also very active in Mexico, helping them stand up their nationwide cap and trade program during their pilot phase. So there's a lot of moving parts there, but I think one of the critical takeaways is that we're actually in perilous times, and I don't necessarily mean because of the COVID-19 crisis, although I think that's really obviously distracting all of us for a lot of very good justifiable reasons. But I think it's critical for all of us to step back and understand that we are in the midst of a serious climate crisis that where COVID-19 could just be one of the harbingers of the challenges humanity has to contend with. We've all heard that the scientists are basically telling us we have until 2030 globally to see a significant downturn in the rate of greenhouse gas emissions. And one of my key concerns over the next couple of years is that the focus is going to be so short term on handling the COVID-19 crisis that other challenges may get overlooked. Many of you have probably already seen articles talking about the importance of also perhaps taking advantage of the current challenges to also consider how to on the climate side. And there's a lot to be done, not the least of which is to change that equation where we've only got RGGI and California involved in cap and trade. the now defunct Clean Power Plan arguably would have led to about 3/4 of the US states involved in a cap and trade program. It's safe to say right now that, frankly, there's just very limited action to contend with dangerous human impact on it, and we are sorely running out of time. So the old adage of, never leave a good emergency or crisis, let it be wasted, really holds today. We have the opportunity to redirect the economy in a more sustainable, greener fashion. It's not clear to me that we'll take advantage of that, but I think, as Dick Kemp was saying, one of the key drivers right now is the fact that so many companies are interested in accelerating their action on climate change, and there's a lot of momentum there. And it's certainly not being led by public policy initiatives. It really is initiatives by the companies themselves, trying to determine what's the most aggressive actions they can take. And there's a lot of things we're currently doing to try to accelerate action on that front, including a recent emphasis the last couple of years on more natural working land solutions, whether it's increased forestry projects, or we're currently working on a soil enrichment protocol that has the potential, or reforestation activities. I mean, there's a whole menu of potential options there that have potential to do a lot of good, not only for the climate crisis, but for other ecological reasons as well. And it remains to be seen what sort of leadership that we see moving forward. I know there's a tendency to always wait for the public policies to pronounce this is the way we're going to handle it. I've been working on the climate space for over 30 years, and the sad reality of it is we're out of time. We're heading into COP26, whenever that's going to be held, and it's gotten to the point where many of us are forgetting how we're numbering them. And the current international debate is focused on still setting up the rule books for the Paris Agreement, which the current administration has claimed that the U.S. will exit later this year. We'll see whether that happens. I suspect it will. So the tea leaves, if you're looking at them, are rather tragic for the collective train wreck we being humanity are heading for. So there's a lot of good things happening here in California, but as we heard from a couple of the other panelists, moving forward, there's going to be reduced use on usage of offsets beginning next year, and that's going to hamper action on it. California has helped light the way that you can grow the economy, you can have a cleaner economy, and that really is key. But California has a lot of work to do as well, unlocking a cleaner transportation sector probably being the most critical. We'll have to see how that evolves in the coming years, but that is fundamentally one of the key areas to watch. We need to continue to remind people that we'll get through this crisis. None of us obviously have a crystal ball that tells us exactly when, but that doesn't mean we can forego action on other critical priorities. And the climate crisis is just as foreboding, if not more so, than the COVID crisis, because we're talking about fundamentally making this planet inhabitable in large part if not enough is done. Thanks, Dick. I'll turn it back over to you.
Thank you very much. Appreciate that. Let's see. I think the next up is Michael Karam, who's with First Environment. Michael, do you
Sure.
care to go?
You can hear me?
Yes, can hear you. Yeah.
Very good. Thanks, Mike. Good morning to everyone. Wanted to again thank Mike Newman and Parhelion and Opus as well for having and convening us here this morning. Much appreciated. As Mike said, I'm Michael Karim. I'm with First Environment. We're an environmental engineering firm based in New Jersey, although we do have a nationwide presence. I'm here in Southern California. I spend 100% of my time in our greenhouse gas management practice. And in that group, we focus on validation and verification work. We do work in all the major North American voluntary and compliance markets, some international markets as well. But focusing on compliance markets, obviously the big ones in North America are the California programs. And we are an accredited verification body in 3 major programs in California. the mandatory reporting program, the cap and trade program, so that's offsets, and then the low carbon fuel standard, the newest program requiring validation and verification. Wanted to give some thoughts on what the verification space looks like in light of coronavirus and everything else that's going on. I guess the first thing I would say is that businesses continue to be good for us, so that's a welcome surprise. However, I think we always keep in mind that verification by definition is a historical activity, right? We're always looking back at emissions that happened in the past. So for example, right now we're doing a lot of verification of 2019 reports, obviously before a lot of this hit. So that being said, we are a lagging indicator, I think, of the market. Thankfully, we haven't had any cancellations or any verifications being pulled back yet, but we'll wait and see and continue to be cautiously optimistic. That being said, I wanted to talk a little bit about some of the challenges that we have doing verification in the current environment and what that might mean for the offsets market and project developers out there. The verification, it does tend to be largely a desktop exercise. I often say if we have a internet connection and a telephone connection and electricity, we can do our jobs, and meaning we can do them from just about anywhere. So from that aspect, having everybody out of the office or working at home really hasn't been too big of a challenge. But the central challenge, of course, with verifications is site visits. So typically in any verification, there is a programmatic requirement to do a site visit, usually on an annual basis. Sometimes there's other timeframes that apply, but in general, most third-party verifications require a site visit in order to complete the verification process. That has obviously been the big challenge with travel restrictions and people's general reluctance to get out and leave their homes. So we've had to be a little bit creative with that. I'd like to think that we've been a little bit innovative in terms of how we've conducted some of those site visits. Last month, we pioneered what I call the contactless site visit, trying to do site visit entirely over phones and from our vehicles. That was kind of interesting, but I think we were able to achieve all of the necessary safety precautions and protocols, but still get the work done. So that was exciting that we were able to find a way to make things work in light of all the in light of everything else that's happening in the restrictions or prohibitions on other things that it might put in place. I think that begs the bigger question, though, is that possible at all sites? I don't think the answer is yes. I think the sites we've been able to do this at are sites where they're relatively open, outdoors, things where you can facilitate physical distancing and have any conversations over the phone. There's other types of facilities and other types of sites where I would imagine it would be hard to do the site visit and maintain the necessary health precautions that you would need to. I guess where I'm going with this is I'm curious to see in the next year how programs and regulators, particularly ARB, keep up with this. As far as I know, the regulations aren't changing. The requirements for site visits are still there. And those requirements are important. One of the bedrocks of verification is getting to reasonable assurance. So that's the standard that most programs require in the verification, that it be conducted to a reasonable level of assurance, that the verifier be reasonably assured that the emission reductions as stated actually occurred. And obviously a site visit, seeing it for yourself, seeing the processes in place, seeing how data collection happens, seeing the instrumentation involved in data collection is all very important. And I really think there are limits to what you can do with what I would call a FaceTime site visit. So we have heard some other verifiers and some projects being done remotely. I don't think that's the case for all projects, nor is it possible in all projects. I think there may be limited exceptions where somebody's been on site in the past and it's more of a checkup or a re-verification where that could be a possibility. But I am very curious to see how things change over time in terms of site visit rules, whether we'll see any relaxation in those or any changes in those. I think that will be the probably biggest impact on the verification process going forward. But that being said, as I said, we've continued to do our work primarily through desktop reviews, the ones that we can do through desktop reviews. It's surprisingly business as usual. So I'm a little bit sanguine about the future. I've heard, as you've heard from some of the other folks on the webinar here this morning, it sounds like there will be some tempered demand for offsets a year from now. That, of course, makes us a little bit hesitant or gives us some pause. On the other hand, I look at the ARB cap and trade program. There are over 800 reporters in the mandatory reporting program, and not all sectors are down. I think of things like paper products, as Dick mentioned, anybody who's in medical manufacturers, medical equipment, and then food and ag. I don't think any of those three segments or sectors are doing poorly right now. If anything, they're going the opposite direction. So I'm interested to see a year from now where the demand lies, or if demand in some areas is dropping off. I would wonder if other sectors might pick it up. I guess that being said, maybe I'll turn it back to you, Mike, and happy to take questions from anybody on the line later.
Thank you very much, Michael. Yeah, the system relies entirely on your reasonable assurance of the verified facts, so thank you for that. We have one question that I'd just like to put, and I think since this is agricultural based, this is probably to Dick Kemper. Question is this: what is the status of HR 3744, the Agricultural Environmental Stewardship Act, which would have created new broad standalone 30% investment tax credits through 2021 for both facilities like AD that produce green gas, renewable gas or RNG, and facilities that recover nutrients from digestate or livestock manure? Dick, do you understand the question? I'm not sure I do.
I understand the question. I'm afraid I don't have an answer. Maybe someone else on the call does. We're pretty much primarily involved in timberland, and I'm not familiar with the resolution that he or she is talking about. Unfortunately, sorry.
It's okay. Well, I'm sure our next panelist will have some thoughts on that. Let me introduce Richard Sains. Rick is with the Pollination Group, a lawyer and very well versed in all of these matters. Rick, take it away.
Thank you, Mike. Thank you. Thank you to Parhelion and Opus as well. It's an honor and a pleasure to be on this panel with some of my folks I haven't seen in a long time, physically or virtually. So it's nice to see you virtually, I guess. So I thought I would try to take Bridget's contango, Craig's habitable planet, Dick's toilet paper, and Mike's waste gas, and the other Mike's verification of the prior Mike's waste gas, and figure out how all those things actually come together and why. And I think it's worth stepping back just a little bit on markets. So trading, offsets, market fundamentals, they're not the end. They're a means to an end. And this goes to something that Craig was getting at. So cap and trade systems are means to achieve economically efficient reductions in greenhouse gases, which are political decisions that set targets for reduction that are achievable both from a science perspective, but also a political perspective. And in terms of the COVID response, I think we're hearing all of the depression in the demand and the softening of the demand signal, and secondary markets going below the reserve price. It is a feature of the nexus between economic activity and greenhouse gas emissions. Our economy has not decoupled yet. It's in the transition period of decoupling. Renewables are substituting for fossil-based fuels, but that is a transition period over a longer period of time. We need to accelerate it. We need to do way more, way faster, as Craig is saying. But the fact that the market prices have gone down is not an indication of some sort of fatal flaw in the market architecture. The market prices are flexible prices that are based on demand and supply, and the supply here is policy driven, right? The demand is driven by economic activity, and the supply is policy driven. So when you set a policy and say we have a target of this reduction by 2030, 45% below 1990 by 2030. That's set on the assumptions that are made at the time you make those policy decisions. So one of the critical questions that I think we all need to think through around what is the long-term, short, medium, and long-term response to COVID in the markets is going to be, what's the political response going to be? And so, Craig sort of alluded to this, but and Mike, I think too, every conversation in every government around the world, maybe with the ridiculous exception of the United States, is talking about green stimulus. How do we rebuild better? How do we learn from this? And governments, central banks, they're all going to have to infuse huge amounts of stimulus into the economies to get them to recover. And almost without exception, that is a discussion about how to do that in a green way. So what's the role of the markets in doing that? I think there's still a very important role for markets, because as Craig was saying, we're at COP26. We still have such a long way to go in terms of the collective level of ambition that governments have set to reduce the greenhouse gases to be in accordance with science, that we have plenty of headroom to ratchet down on targets. And if we have extra headroom because now we have a long-term economic recovery that needs to ensue, and the targets that were set are sort of not fit for purpose anymore, well, it seems to me that governments will be forced to ask the question, should we be revising our targets and our trajectories? And so my expectation is that it's not going to happen in the next 6 months, maybe in the next year, but as the economy starts to get back, and we'll see how far the airlines rebound. Will the airlines rebound to 100% of where they were? And that's going to have dramatic impacts on the relevance of the markets like CORSIA, this global aviation market that both Dick and Craig were talking about. That's an offset market. This technology is tricky. I'm getting a delay. Anyway, so they're not totally static things. Markets are flexible systems, but they're also policy systems. So the pricing is responding to the immediate crisis, and then the policy will also respond to the crisis. And we'll see what that does to the market dynamics in terms of supply and demand. That's one thing I'd say. I do think it is worth noting with respect to California, because I know we're focused a lot on the US here, that California is an amazing policy system that has withstood so many difficult challenges and lawsuits, and there's a lot of people who don't want California to succeed, and currently the federal government is among that group, and they are suing the state of California for its linked auctions with Quebec under a foreign powers doctrine theory. And so far, California has withstood all of these challenges, but I suspect it will survive this as well. It's my take on it. But it never ceases to amaze me how resilient California seems to be in face of challenge after challenge after challenge. But for those trying to prognosticate about the future of California, you've got COVID recovery, you've got the federal lawsuit, but you also have, as Craig said, a working model that has demonstrated that you can actually grow the economy, achieve really significant emission reductions, and that markets actually work. And so at the end of all of this chaos and dust, and when the dust settles on this, I actually think, once again, California and the California market will emerge as a exemplar for how to do it right. So I'll stop there, and then we'll get to questions. I know we're only about 10 minutes.
Thank you. I think it probably helps California that it's big compared with the rest of the United States. That probably gives it some robustness. We have a question, and I encourage any other questions from the floor. And this question is for the offset panelists. How is the coronavirus pandemic affecting the economics of developing WCI offset projects going forward? with lower emissions in California and Quebec, do you foresee obstacles with developing future projects with less compliance demand? Additionally, how might problems with conducting verifications impact California offset supply in the near to medium future? And will this disproportionately impact certain protocols? It sounds like about 3 or 4 or maybe even more questions there. Rick, let me throw this one first to you, and then if there's anybody else on the panel that would like to take a crack at this, by all means. Craig, I know I can see you can afterwards. So Rick, please, first.
Yeah, well, I'll take a crack at it. I mean, it's a very good question, and it sort of basically speaks to all the points we were making on the panel. I mean, so I think there is going to be a short-term impact. I think we're all sort of waiting and seeing. But remember, there is banking. So you have. I think there will be those that are still interested in acquiring offsets that think that they can get them at a good price right now, given the relative supply demand. It's not everybody in the market operates on a sort of just-in-time, immediate compliance need where they go out and procure what they need and then they make it to the next auction and they, so there is a market, and I think there will be buyers that are strategic around, acquisition of offsets even in this period of time. Having said that, it is what it is, and the economic activity has been dramatically depressed. And the California cap and trade system isn't immune to that. So there will be impacts, and I think that it's safe to say that's the case. But over the longer run, if you see this stuff start to come back, I think it will rebound quickly. And actually, Bridget's data on where the secondary market prices of CCAs have rebounded nearly to where they otherwise would be is pretty remarkable, frankly, because it's not as if the economic activity is shot back up to where it was. We're still essentially in lockdown. So that's an indicator as well. I'll stop there and let others chime in.
Yeah, thank you, Rick. Craig, I think you had some thoughts on that too.
Yeah, just to add to what Rick was saying, on the compliance side here in California, let's face it, the offset market is facing headwinds. We're dropping from 8% allowed to 4% allowed starting next year. Half of those need to be offsets that provide direct environmental benefits to California. You combine that with the economic contraction we're currently experiencing, and there's no question that there's a softening of the market on the compliance side. On the voluntary side, it's more of a mixed picture, but it's tied to more, I'll call them imponderables at this point, on how quickly will corporate action across the country ramp up interest in the voluntary offset market. We're seeing a lot of interest, as I mentioned earlier, across the board, but that interest needs to translate into investment in action, and that's obviously much more limited. I think many of us were very optimistic that the CORSIA market would offer an additional upswing in demand here moving forward. The reality of it is we all know what's happening to the international aviation industry. The IATA has already asked ICAO, International Civil Aeronautics Organization, to redefine the baseline, which was supposed to have been an average of 2019 and 2020, and say, let's throw out 2020 and go with 2019. A decision like that, where under CORSIA, all they're agreeing to do is to mitigate the growth above that baseline, potentially could mean virtually no action in the pilot phase and call into serious question the credibility of CORSIA. So we'll have to see from a policy perspective what decisions get made around that program. We all know that aviation has been a keen major global contributor to climate change, and climate change is only growing. But yeah, we're going to have to wait to see how quick, what decisions get made to establish that baseline, and then how quickly the aviation industry as a whole recovers from the current pandemic impact.
Yeah, thank you, Craig. I think, Michael, with First Environment, you've got a question in this for you. Additionally, how might problems with conducting verifications impact California offset supply in the near to medium term, and what this disproportionately impacts certain protocols? Any thoughts on that, Michael? I think you're muted.
Okay, there we go. Sorry about that. As I alluded to a few minutes ago, the site visit requirement is the kind of the sticking point in these verifications right now, and it has the potential to delay them. You do have a certain timeline or time frame in which you have to conduct the verification following the conclusion of the reporting period. We have yet to be in a situation where that has caused a verification to lapse or to not get verified. Frankly, I don't know how we'll deal with that. I mean, I think that is the central question in verification right now is, will these programs or will these regulators bend their rules or adapt? I wonder what the lasting impact will be in terms of site visits and how we do that. But yes, that is a very salient point. And then, we'll see. I think we'll probably have the first test case coming here in a few months when somebody comes up against their deadline and we haven't conducted a site visit. With respect to different project types, I'll admit my expertise is not in forestry, but you heard Dick Kemka say earlier that they've had to postpone a site visit due to coronavirus. So I'd say that protocol is probably one that's at risk because of the amount of field work and travel. I mentioned earlier there are some sites that we're able to do. I think sites that are outdoors, dairy farms, livestock operations, mine methane. I think those site visits are feasible if you can get to the site, if it's within driving distance or a day's drive. Other protocols that are maybe more indoors, I'd say, things like ODS. I think those could be more challenging, and we'll have to see what the regulatory response is in terms of relaxing any requirements for site visits and whether there's a pathway to still get to reasonable assurance in a verification conclusion without a site visit.
Yeah, thank you. Yeah, that answers that question.
Side. We have already had requests from verifiers to modify the rules, and we don't have any across-the-board guidance at this point. We're addressing it on a case-by-case basis and trying to be flexible under the current circumstances. We're going to push the verification firms to try to resolve any outstanding issues, but then urging them to come back to us to highlight what those issues are. And we have made allowances, and everyone's situational dependent. So no blanket assertion I can make right now, but Michael's absolutely right. We're going to need to be more flexible moving forward until we figure out a better way to work in the world.
Thank you, Craig. Yeah. Bridget, I think there might be a question in this for you too. If we could just go back to it. In your view from the carbon market desk at Opus, how is the coronavirus pandemic affecting the economics of developing WCI offset projects going forward? You have any thoughts on that?
Well, I can tell you what I've heard about offset projects. The economics right now, and this is mostly, I mean, we're doing a lot of looking into Corsia right now, and this is going to mostly, I guess, relate to that. And looking into REDS markets, we've heard that, some of the scheduled, sorry, it's probably up here. Yeah, some of the scheduled projects that were, going to be done are going to be on hold. A lot of this is going to be on hold at this moment, especially, and it kind of goes back to the airlines as well, just trying to get back to, their bottom line and, their revenue streams and what they can, just to survive in this environment. I feel like, from what we've heard that, projects will temporarily be on hold. Now, how long that will last, we don't really have a handle on yet. We've heard anywhere from, a year to 2 years. Corsia is just in the pilot phase. So you don't, it could be a little while until these airlines get back interested in ramping back up, to go into that voluntary phase, I suppose you could say. So yeah, that's what we've heard from our viewpoint.
Yeah, thank you. Please.
Mike, I can give you a little bit of a project developer's perspective on the demand. So the forestry type is by far the largest, I think you've heard on for California compliance types. And as a developer, it takes us anywhere from 12 to 24 months plus sometimes to get a project from start to finish in terms of issuance in the state of California. So by that time, we're post 2021 if we're starting at new projects today. And the front end cost of doing that depending on the size of the property, can be $50,000 up to $500,000 that we have to outlay before we get the project issued and sold. And so for us, the COVID issue is, it's going to be very challenging for us to do any more compliance projects unless we buy land in California, because it takes so long to get the projects developed and approved. And I think there's going to be some demand hiccups here over the next year. And if you talk to Mike on the phone call, Mike Emerson and others, they plan in their compliance purchases through 2021, and then they look at post 2021. And I think a lot of people are already looking maybe at post 2021 for the purchases. In other words, their bins for the compliance period before 2021 are getting pretty full. And at any time, there might be 18 to 20 projects in the queue to come to the Air Resources Board. A lot of them in Craig's, in the Climate Action Reserve, some of them in the American Carbon Registry, and nobody really knows what the volume of that is, except maybe a few developers that span all of those registries. So my 2 cents worth is it's a long and winding road for getting projects developed and into the system, and it will impact the supply.
Yeah, thank you. Mike Emerson at SoCalGas, do you have any thoughts on that?
Yeah, no, I can comment on that. And I think the question was really about the impact of low prices, offset prices. And I know for us, I guess two things. One, we certainly like the lower price. I mean, it translates into lower costs from our customers. But what I can tell you is over quite a few years now, we've developed some really good relationships with folks in the offset space. And these projects, all these projects are, very impactful to the quality of life for our customers. I mean, they're doing really good work with forestry conservation, reducing dairy emissions, capturing mine methane, so on and so forth. And I know I talk to these suppliers all the time, and I know the impact of this low price environment on their business. I mean, these guys aren't making a ton of money doing this. And, our concern, I mean, we take kind of a long-term view. We see the very positive work being done here. And we would like to continue, connecting with these entities so we can reduce our carbon footprint. So it is concerning, how the lower price is potentially impacting their economics and making it difficult for them to, make a business out of this.
Yeah. Rick, I think we should allow the lawyer to have the final word on this. Any additional thoughts on that question?
Yeah, I mean, well, it's interesting. Dick has way more insight into this because this is his deal. But we advise a lot of other offset developers, and particularly in the reforestation and forestry space, and they're actually seeing a real hard time meeting demand. Now, it's not compliance demand. It's not demand that's based on RBOCs or CCOs. I just thought I would actually use those acronyms, Mike, because you had prefaced that we would be
using them.
Thought I would do that. It is this voluntary space, and I do think there's a really it's an important thing to remember. Again, these are means to an end, and so if companies, based on their own ambitions, based on their own, license to operate, their consumer base, etc., their integrity, they say we want to go beyond what we're obligated to do. That's where some of these projects come in, and I think my view is that is actually going up. There's more of that happening. Look at Microsoft, look at Delta. Now, yes, of course, COVID is a huge disruptor, but the fundamental trend in all of this is not going away. And as Craig had earlier said, it would be a great luxury for us to say we've solved this challenge and we're not going to have to worry about this when we get back from COVID. The reality of it is it's staring us right in the face. And so all of the fundamentals of the need to dramatically reduce greenhouse gases, dramatically increase sequestration and the net in net zero, and have policy mechanisms to be able to efficiently respond to that they're still there. And we're only going to have to ramp it up. And in a year's time, we're going to have to ramp it up more and more and more. So the long-term fundamentals of all of this, in my estimation, are still quite compelling. And, you know, we're just going through a very challenging time right now. That's what I'd say.
Yes, we are. Well, thank you all very much. We've slightly overrun our allotted hour. I think we have something like 130 registrants this morning, which surprises me that there is so much interest, but it's a very good, reassuring thing to know there's so much interest in what's next for the carbon market. So on behalf of Parhelion and on behalf of all of our expert panelists, I'd like to thank everybody's participants. Excuse me. We will make a recording of this available to anybody who wants it, and a summary of comments. And I wish you all a very good day. Thank you very much.
Thank you, Mike.
Bye.
Thanks, everybody.
Bye.